Happy day. I welcome you all for today's lecture on cost of capital. Capital is a fund which is invested in the business in expectation of a return or profit. There are various ways in which finance or money can be raised, and the most common ways of raising finance for startups and small scale businesses are using their own personal savings or borrowing from friends and family, or they may even borrow from banks and other financial institutions. There are also various other ways of raising finance which can be classified based on time, based on ownership and based on the source of generation. So, when we look into the classification based on ownership, it can be classified into two, the owner's fund and borrower fund. Among this, the most common sources of finance are these three: financial institutions, or raising through equity, or raising through debentures. So, any amount that we borrow, the lender of the money would expect a return. For example, when we borrow money from banks, we have to pay a return to the banks. It can be monthly or half yearly or annual payment, which is called interest, in addition to the principal amount that has to be repaid. So, that is called cost of capital. Any capital that we borrow, there is some cost attached to it, which is called cost of capital. So, cost of capital is a minimum rate of return which is expected by the suppliers of the fund. It is a price that a business incurs in order to finance its operations, and it is also used in capital budgeting in order to evaluate the cost of a new project if it is profitable to take up the project and to be justified by its cost. So, these are the various definitions that are given by various authors. Hampton John says cost of capital is the rate of return the firm requires from investment in order to increase the value of the firm at the marketplace. Equity shareholders will always want a fair return on the investment that they have made, and the cost of capital will also have an impact on the company's share in the marketplace. So, the cost of capital should be at a nominal rate in order for the company's shares to be priced at a proper rate in the market. And then from the above definitions, we can draw up the following characteristics of the cost of capital. Cost of capital is a rate of return which is generally expressed in terms of percentage value, and it is a minimum required rate of return to offset the effect of risk associated with business and to maintain profitability in order to maximize the wealth of the shareholders. Cost of capital has a role in maintaining the market value of the firm, and the capital invested must yield equal to or more than a rate at which sources are managed to find such investments. And cost of capital always involves implicit as well as explicit cost. Therefore, it takes future risk and business risk into account. There are also various other names for cost of capital. It is sometimes known as the hurdle rate, cutoff rate, required rate of return, or sometimes even mentioned as target rate. So, the company's investment decisions for new projects should always generate a return that exceeds the firm's cost of capital used to finance the project. Otherwise, the project will not generate a return for the investors. So, the initial cost that was incurred in implementing the new project should be lesser than the profit that we get from the investment or the project. So, importance of capital, cost of capital. It is very important when taking these two into consideration, when taking capital budgeting decisions and the mixture of the capital structure. It is very important to look into the cost of capital. So, there are various, like we already discussed, there are various sources of finance, and a company can raise their capital only purely through equity or only purely through debt, or it can be a mixture of equity and debt, and it can also be only preference or preference and debt only, or equity, preference and debt. So, we are going to look into the cost of capital of each of these components. Cost of capital is actually combined. Any company will not have only equity, only debt or only preference. So, most companies will have a mixture of all these sources. So, cost of capital will fetch us the combined cost of all of these sources of finance. So, first we will study about the cost of debt. So, we are going to look into problems on computation of cost of capital. The first is cost of debt, cost of preference capital, cost of equity and cost of retained earnings. So, cost of debt, debenture is loan borrowed by the company. In return, the lender of the debenture money will get interest. It can be monthly, annually or quarterly interest. So, debentures can be of two types. It can be irredeemable debentures or redeemable debentures. The formula for finding out the cost of debt, capital is denoted by the letter K and cost of debt is equal to I divided by NP. I denotes interest and NP denotes net proceeds. Here tax also is taken into consideration in the calculation of the cost of capital. So, the formula for irredeemable debt before tax will be the same, I divided by NP. For after tax we have to deduct the tax amount alone. Okay, now we are going to see an example. Suppose a company issues 15% debentures of the face value of rupees 100 each at a discount of 5 rupees, and suppose further that the underwriting and the other costs are 5,000 for the total issue. We have to find out the cost of debt. Net proceeds is after all these expenses, what is the amount that the company will receive from the debenture, that is called net proceeds. So, I is interest. 100 rupees debentures, 1000 number of debentures were issued. So, 100 into 1000, 15% is the rate of interest. So, 1 lakh 15% on 1 lakh is 15,000 divided by 1 lakh is the face value of the debentures minus the expenses related to it. 5,000 was discount and 5,000 is other expenses. So, it is 90,000. So, up in the calculation we will get the cost of debt before tax for the irredeemable debenture. Next, we are going to see the same example. What if there is a tax bracket that is applicable for the company? In this case, the tax rate is at 50%. The same example I have used here for better understanding. So, 15,000 divided by 9, you get the before tax. At that, if you work out 50% tax, we will get 8.33%. It can also be calculated using this method. KDA is equal to KDB into 1 minus T. So, this is the case of irredeemable debentures. Okay, we will see one more example. A company issued 12% irredeemable debentures of 2 lakhs at par value of rupees 100. Compute cost of debenture if issued at premium and 30% tax rate. So, the formula will be 1 divided by NP into 1 minus T. Here net proceeds is the value, par value of the debenture plus the premium amount. So, 2 lakh is the value, it is issued at a premium of 10%. So, it is 2 lakh plus 20,000. So, which will be 0.1090 before tax, and upon calculating tax we will get around 7.64% as our cost of debt. Moving on, we will see the calculation for redeemable debentures. In order to find out the cost of redeemable debentures, the following is the formula. We will see an example sum now. A company issued 12% redeemable debentures of rupees 2 lakhs at par value of rupees 100 each. Compute the cost of debt if the debentures mature at the end of the 7th year. So, we are going to simply apply the values into the formula. I is nothing but interest, P is the par value of the debentures, NP is the net proceeds of the debentures, and N is the number of years it takes for the debenture to mature. So, upon using the formula we will get the same 12% which is already given in the question, because here the debentures are issued at par. So, when the debentures are issued at a par, the percentage that is already given in the question will be the answer. Moving forward, what if it is after tax rate? In the same question, if there is tax rate, we have to apply the tax rate. Okay. A company issued 12% redeemable debentures of 2 lakhs at par value of 100 each, but if the debentures are issued at a premium of 10% and mature at the end of 7th year, assuming tax rate is at 30%. We are going to use the same formula, but here the net proceeds amount will vary because it is issued at a premium. 2 lakh plus 20,000, it will be 2 lakh 20,000. So, upon calculating we will be able to find out the cost of redeemable debentures when issued at a premium and tax rate is at 30%. Moving forward, cost of preference capital. Preference capital will have a priority over the equity share capital in terms of receiving their dividend. So, again there are two formulas here, the same that we saw in the debentures, the same formulas will be applicable here also, irredeemable and redeemable. So, when it is irredeemable preference share capital, it is DP divided by NP. DP is nothing but the preference dividend that is fixed for the preference shareholders, and NP is the net proceeds. When the cost of to find out the cost of redeemable preference share capital, the following is the formula. We'll see few example sums on this. So, XYZ company issues 2010% preference shares of rupees 100 each at rupees 95. They calculate the cost of preference shares. Here the formula is the same, DP divided by NP, but the net proceeds that the company receives from the business is only 95 rupees per share. So, it should be multiplied with 2000, 2000 into 95 is 1,90,000. The cost of raising money through irredeemable preference shares will be 10.53. Moving forward, we will see an example for redeemable preference shares. The same, it is the company proposes to redeem the preference shares at the end of the 10th year. So, N is to be substituted by 10. Upon applying the formula, we will find the answer. And here we can also use one other method. Instead of multiplying and working out on the sum amount, we can use the face value and the discount value and apply in the same formula and get the same answer. We will see about the cost of equity and retained earnings in the next class. Thank you.